Welcome. Welcome to Mark's Trading. Today we are going to talk about don't shy away from those crowded trades that are making massive moves. Embrace those hot stocks. However, we need to exit before the party is over. And we're going to talk about that today, how to accomplish that. Embracing these hot stocks are the essence of trend following and momentum. As many of you know that we are trend followers, and the fact is trend following and momentum trading is really going out for a longer period of time. Typically these trades could last 70 to 150 days. That is how you get the 20, 30, 40, 50% returns. We are not day traders. Trend following signals are more robust. There's a lot more historical back-tested data that allows you to take advantage of trend following trades versus intraday signals that are not as robust because they lack stronger confirmation of trends. So again, there is nothing wrong with buying crowded stocks that every investor owns. And during certain periods of time where technology is outperforming, you're going to have these top names that are crowded. That might be Apple, Amazon, Google. Don't be afraid of these names that keep trending up every day. However, we do need to know when to hit the exit button. These trades that are going parabolic provide the best gains that we could possibly get into. However, we need to be proactive and not reactive in selling your position. And we're going to discuss how you be proactive and not reactive with some of our modeling. The issue is many technicals, almost all of them lag, and after the fact causes selling after the trend has already broken. And historically, keep this in perspective, stocks that have the greatest amount of momentum typically have a reason. It's either because their earnings are significantly increasing, the sector is having some type of catalyst or positive headwinds that's allowing these companies to have such great momentum, or they have a new business that's creating new profitability. And so as we mentioned, we want to be proactive and not reactive in selling our positions. And as we mentioned, almost all technicals lag. So what is momentum? Because I think that's really important to distinguish for what we do here. Momentum is not intraday, and it's really not short-term swing trading looking out 14 days. Momentum is a factor. Just like value is a factor, risk is a factor, quality of earnings are a factor, and market cap is a factor. So what is momentum technically? Well, it's calculated on a look-back period of 12 months historically. Some quants will use a blended approach where they're using 6 and 12-month returns looking back, and then they'll grade those. And momentum, and you might have heard the term before, relative strength, not the RSI index. You will grade stocks relative strength, which is the momentum of that stock, versus an index, a peer group, or just in general. And whatever has the greatest return on that look back period will have a relative strength score. The idea is to think differently than the crowd on popular overbought indicators. If you're looking at the same exact indicators to determine when a stock is overbought, this is not going to help you diversify away from the crowd. If you are reacting the same way that the crowd is reacting, you're not going to outperform the crowd, which is basically the index. You might as well just buy the S&P and dollar cost average and just forget it. The biggest issue is with momentum investing. You have momentum crashes. And typically, these momentum crashes will give back a large majority of those gains that have been built up over a 6-month or a 12-month period. The problem is with commonly followed indicators, they don't have the ability to remove a lot of momentum noise. So they don't give you a lot of confirmation, and they don't give you a lot of visibility into whether or not you should be holding the position for a longer period of time. Ultimately, looking at the same indicators, it's going to be extremely difficult on a statistical basis to outperform the masses, because the masses is using the same exact tools as everybody else. So let's take a look at an example here of what I mean. Here is Apple. And during the May period of 2020, when it started to go parabolic, and I guess it was around the mid-70s, what I have here is I have a red line that's drawing a shorter term trend line of this parabolic move. Now, you could have easily said, once I get long, I'm going to hold the stock until it breaks its trend. Well, potentially it did almost break its trend here, which is fine. But after the fact, once it broke its trend, we did get out at around, let's say 107, 108. The stock did hit just about 140. So this is after the fact, after it already broke and already had a lot of downside or drawdown. That's one issue. Now, we don't know along this way by just looking at this chart how overbought it is. So a lot of practitioners just use RSI, which I find to be almost worthless for longer term trend following. And the reason why is it doesn't allow you or give you good visibility into the longer term overbought trend. RSI is a good tool if you want to swing trade over a 14 to a 30-day period. Absolutely nothing wrong with it. You probably should use it. But if you're going out 70 to 150 days and you want to squeeze that big parabolic move at the end, it's not a good indicator. And the reason why is, let's say we went long back here when the stock started to firm up, moved above its 20 and its 50-day. The RSI got up to 80, which would be considered somewhat overbought. If you're not familiar, anything above 70 really starts to become extended on the RSI level. And then it worked all that back off. You would say, many technicians would say using this, okay, well, it's worked off that excess overbought condition. We can get back long this again. The point is, it's full of volatility. It doesn't give you any confirmation. It's not a good tool to remain in the trade long enough. Then once again, the second time we reached overbought, we then corrected again below the 70, and then you had a third time back up to 80. Nothing, and then finally it worked nicely on the fourth attempt over that 4-month period. But the point is, the momentum volatility within the RSI or the price series doesn't give you a confirmation, and it's not robust, and looking at trend following overbought conditions on a longer period of time. Now you could say, well, look, I'll get long at this point on a shorter term basis, a 20-day, and when it breaks the 20-day, I'll sell it. Well, that would have stopped you out very early on at that 93 level. So you could have said, well, I'll sell it when it breaks the 50-day. Well, it broke the 50-day basically at the medium-term trend line. It's trying to capture the returns using moving averages lag significantly, even if you're using shorter term moving averages. It doesn't allow you to stay in long enough. There is no perfect holy grail moving average that allows you to capture everything and also exit, mitigating the risk before the trend significantly breaks. So let's take a look at something that does work. Here is our proprietary models, and what we have here in the green are our rating value that measures the trend strength. Once we get up to a 60, it starts a strong buy. You'll see that in the indicators you can see up here. But for this example, let's just look at what's more important so we could be proactive. not reactive. So once we max out at the max rating, there's nothing to do and look at in terms of the rating value. What I do then is I look at the counter trend. This is measuring exhaustion and overbought over the period of time that we've deemed to be most relevant for the gains that we're looking for. So as long as the red lines keep moving further south, we want that. There's more buyers stepping in, there's more sellers stepping away. Once we max out at that rating and stall or reverse, we will start taking our positions off the table. So here at an 89, we wouldn't be selling along the way here because we're not overbought yet. But once we do hit overbought and stall at this 89, we're going to be reactive. Yes, could the stock go up another 20%? Absolutely, it could happen. But the point is, what our models are saying is, for our time frame, our return that we're looking to gain, we're looking again for 20 to 50% returns over a 70 to 150 days. This is saying, okay, the stock has appreciated as much as it can. The risk is not warranted to remain in this position any longer. We now want to exit that position. What you'll notice though is we do a very good job in removing noise from the price series. So here was very weak. We're building up strength in terms of the trend. We finally go to a buy, and then the counter trend just keeps moving lower and lower and lower and lower and gives us great visibility when to buy and sell. And it's very easy. The alerts come into the system and you'll be notified. So that, when we talk about having a robust trend following model, this is exactly what we are referencing. See you in the next video.